Rodrigo Neshimbeni, how are you this morning?
Fine, Mark. Thanks. How are you?
I'm very good, thank you. Rodrigo, you're the portfolio manager of Shore Fund. Shore Fund
Right.
is an FX fund, but unusually, your approach is completely macro and geopolitical approach rather than a
Right.
technical approach, which is very unusual for a forex fund.
Yes.
The looking at the markets, the S&P 500 just inches away from its record, and it's Friday evening, and therefore it should get sucked maybe towards that record. Um, we're not very far away from it now. Is 2024 going to be about buying stocks just because of a reduction in interest rates?
Yeah, that's a very good question, Mark. It's very tempting at this point to look down at the path of 2024 and think, oh, yeah, it's very obvious. This is a very clear cut case for being long equities throughout the year for the next few months because the Fed is lowering rates, right? So it's once again, we're looking downhill now back to down the road at zero interest rates again, and then Kiwi more down the road. And so monetary expansion, of course, bringing all asset prices of all everything, equities especially, upwards. But I don't think that's a very that as obvious as it seems, and I don't think that's actually a good strategy for 2024 in regards to equities and monetary policy as a whole. Because the Fed will lower rates, because inflation is giving them the opportunity to. Inflation is subsiding. We have seen the peak of 2022 actually at 9.1% in the US, 8-ish% in the UK and the EU, but not so fast because they cannot mismanage this now. The Fed has been very careful with raising the rates now after they started late. Remember in the beginning there was that the transitory speech where they were hesitant in beginning to raise rates, and eventually when they started they had to catch up. So they were very fast. It was the fastest rate hiking cycle in history, even faster than when it was 15% back in the 80s. So and now the worst thing that the Fed could do would be a very messy communication, a very messy outcome if they lowered rates too soon, only to see inflation coming back to the surface, and then they having to interrupt or even worse reverse the lowering cycle intermittently. So the record S&P that we're about to see in the next few hours, most likely these things are magnetic. Once they get that close to record highs, they're self-fulfilling. It will get there. That is being propelled, and to a large extent, by the expectation of many rate cuts from the Fed this year, so much as 6 rate cuts. The market went ahead, head over heels, I think, and exaggeratedly pricing 6 rate cuts. That's way too much. The Fed will not start as soon as March, and will not be able to implement 6 because they only meet 8 times a year. So that means every single meeting after March, or skipping just 1 or 2, they will probably start around the mid uh, the year, and they will do 3 to 4 25 basis cuts this year, if that. Because there will be, of course, retracements of inflation. There will be these air pockets of inflation appearing to come back up. And then they will be hesitant, and there will be press conferences where Powell will be saying, well, we don't know about the core. It's not on a preset course, as he likes to say. And so we will wait and see. We're concerned with inflation coming back. It's not that obvious that inflation is subsiding quickly. I think it is subsiding, and I think it will come down, but not as fast. So the point being, in regards to the S&P and equities in general throughout the world, not only in the US, that it looks like a very rosy scenario from January, but it will not be that. One would have to position very tactically in and out. I think it would be a very a bad strategy to buy and hold for the remainder of this year. It usually happens in January. There's a lot of enthusiasm, a lot of January's tend to, and remember a couple of years ago now there was record oil prices in January. There were and then forecasts for the year that are beaten on the first weeks of the year, and then it unwinds and it comes undone. So I would be very careful with enthusiasm, with being over optimistic about the S&P and buying into the crowd, following that trend, especially at these levels.
I understand. So I would categorize you as being less bullish on the drop, as it were, in the speed and the drop in interest rates and the number of interest rate reductions than the majority of the market. You're one of the more cautious ones. If I imagine the Fed is worried about dropping too soon, just in case this is overdone in terms of the reduction in inflation, and this is overstating the point, and maybe inflation could creep up again in the next few months. They definitely don't want to find themselves in that situation. If the market is wrong and the Fed cannot start to drop rates and inflation stops here and maybe starts to creep up a little bit, what is the effect on markets, but especially on sovereign debt?
That's a very good point, and a very possible scenario now with the geopolitical risks somewhat materializing around Iran. That's a topic for later, but I wouldn't be worried about China, Taiwan. I wouldn't be worried about Russia, Ukraine. I wouldn't worry about Israel, Gaza. But Iran may be a point of concern. That would bring about inflation. That would bring inflation back. That's a risk to the scenario as we see it from today. Inflation seems to be over. The peak seems to be in the past. Commodity prices are relatively under control, especially paradoxically, oil is still not too high. The risk is that inflation comes back to bite, and because of an expanded conflict in the Red Sea, dragging Iran into the mess outright. They are already, but via proxies. But if there's an outright war, then the oil prices would go further up. Conflicts in the
tell me, that's an interesting point you just made, because I think there's an embargo on Iranian oil generally from most parts of the world, isn't there?
Yeah.
How could Iran continue to not be allowed to sell its petrol to three quarters of the world? How could that have a shock effect on petrol?
Paradoxically, an outright war involving Iran from this point onwards, it would be more inflationary because of the Red Sea route, that being just completely closed for safety reasons, and so everything having to go around other more expensive and longer routes, and not only oil but other commodities in general. Not produced or consumed by Iran, but logistically involved in transit. So being to be inflation where it is, it could easily be stoked up by logistics, which is by the way, what happened during COVID, right? It wasn't the virus or the lockdowns that brought about the big burst up in inflation. It was mostly the logistics. There were no containers, the freight forwards weren't there, so the people wouldn't, the supply was significantly disrupted precisely by that. And then the demand was stable, but the supply was disrupted, so the price went up because there just wasn't stuff to buy. And then the invasion of Ukraine emphasized and reinforced that because of the lack of fertilizers and some products that were produced in the region. So it's a delicate balance of global logistics that can be easily knocked off its course, and that is inflationary. If we were in the context of 2015 to 19, where there simply is no inflation, the world is so efficient in matching the supply with demand that inflation simply disappeared, then okay, if there's a broader Middle East war, yeah, it wouldn't be much impact. But now, what happened was, the commodities prices went up, excuse me, because of logistics, because of supply constraints, and then, as it usually does, it was very slow to follow the services inflation, which is what we're seeing now. The goods component of inflation is gone. What's keeping inflation somewhat relatively high is services, because the salaries are the last component to go up. First, it begins on the commodities, first on the food commodities, then metals and mining, services, and salaries. That component of inflation is still happening. It's still developing. The good component, the products component of inflation is okay, is under control, it's balanced, consumption is in order, it's matched. But if in the context of higher services, higher salaries, we bring that on top of that, a disruption of supply of goods, of commodities, agri and metals and mining. That's the worry. That's the concern and the consequence, I think, of a broader war involving Iran. That would, especially if Russia decides to side with Iran.
I understand.
Yeah.
So I think you're siding with Jay Powell, who was asked if inflation had been supply driven or demand driven, and he's saying exactly like yourself, it was supply driven. In that case, why is inflation coming down and reacting to a rise in interest rates?
Actually, someone asked Jay Powell that question in one of the press conferences around 6 months ago, and they asked him, "Do you think this is supply or demand driven?" And he said, "We don't know yet. It seems to be supply driven. Apparently it is. I think it is, but there could be a component of demand there as well." And the way we will know this is now in the lowering part of the cycle, because when they start to lower rates, if it was demand driven, then inflation should come back up. Because if the demand was what was bringing inflation up, if prices were going up because people were buying too much of it, not because there was a lack of it, but because there was too much demand, then you tug on that string in the Keynesian dynamics, you're rising interest rates, so money becomes more expensive, people are buying less things, and then inflation comes under control. It seems you could make an argument for that case being what happened. One could look at it at what we are now, where we are now, and say, well, it was demand driven, because then the Fed, central banks all over the world, raised interest rates, inflation came down. But if that's true, then when they lower interest rates now, inflation should come back up, right? Because then people will start consuming more, and new routes, new container shipping providers, all that. That's what brought inflation down, not the rising of interest rates. So now that the Keynesian mirage is in place, where they are okay, they brought interest rates to a high level, and inflation came down. So the proof is in the pudding now. If interest rates are lowered, will inflation come back up? If it's demand driven, it should. But I don't think it will. I think it's. I think even with lower inflation, lower interest rates, even if, let's say, in 1-2 years' time, it will be back at zero interest rates in majors, in the ECB, BOE. Japan has always been. They're doing their own thing there. They never gone out of zero. But even when interest rates are back to zero, we are still going to see no inflation, just because of many aspects of the way inflation is measured. The baskets are a bit outdated. Like, the inflation is being measured in the fare of taxis and of hotels, and people are staying at Airbnbs and riding Ubers. So it's the difficult.
Rodrigo, I think that's all we've got time for today. I want to thank you very much. I hope we'll be speaking to you next week.
My pleasure. Looking forward to it.
Bye-bye.
Bye, Mark.